Welcome to TradeTheMBI.com. This is John. This report is for the 23rd of March, going to be for Monday. We just ended Friday, and, we achieved a record decline, sharpest decline since, the 29 crash actually exceeded it. So, beat the Great Depression as far as this decline. We saw it all the way back up here. Once we started our DOC spread, we were at our peaks up here in the 3380s. We started getting clear separations of cyan to green, and that took place right after the holiday, right around the 18th, right around that 3358 close. And then by then we saw that green was not going to move across, and then really once you had orange spiking, steel caught in the middle, and green breaking lower at 3358, it was time to say goodnight. And it's when I was talking about the way to defend yourself if you wanted to hold on to stocks was to buy long-term puts, 6 months or greater, at the money or slightly in the money, to create a married put situation. That at least would guarantee that as it drops, you haven't really lost anything because of the increase in value in the puts, and then at a certain point when it based, you'd be able to then sell puts lower to pay for that outcome. Either the other choice was just selling, but of course there's the tax implication with that, which that was the alternative to express for that. So within this decline, we had this blue candle. Now all this blue candle represents is you had magenta shakeout and yellow, where yellow crosses above. And you're still below the negative 13.5 with that. You're supposed to be seeing green rising from a negative level. You're also supposed to be below 38% to see those blue. And what it's basically telling you is that, start to look for buy configurations. Now, in this particular case, it's also supposed to represent a red DOC rise. That didn't take place in this. I'm going to double check where it's reading off of those DOC readings, because when we look at the red DOC, went from negative 1807, negative 1833, so it's still declining at that point, but then it goes up to 1827, so effectively that is slightly higher. So maybe just a matter of putting a condition where we need to see better than a quarter to a half point. I'll double check it to see what the best scenario with that is too. And particularly, we wouldn't be buying on making new lows, so I have to add the fib holding, which is a situation where I don't like to see long setups when you're making new lows until there's been a stabilization of the low for at least a couple of bars. It just indicates that you've then had enough basing. Now, yes, you're going to miss violent snapbacks, but we pick those up above the 23%, or when you have a situation of green significantly popping above cyan, breaking into a new zone, that kind of situation. So did we fill our 2319? Absolutely. That next range would be the 2030 range, and then below there back to the 1600s. And this is just a facet of the complete credit crisis that's existing both in derivatives. The Fed is applying money to a lot of these hedge funds that they were playing some of these risky arbitrage games with treasuries and FX, and once you get on the wrong side of them, they don't make a whole lot, but they do it in such huge leverage. You take a couple $100 million and turn it into 3, 4, 5 billion, and then when something goes sideways outside normal ATR ranges, the same thing that happened in 07 and that with the derivatives, and then it froze liquidity in the markets. And this is where some smart ones like JPM that's pulled out of the repo setups and stopped providing liquidity to some of these hedge funds, and that created that whole liquidity crisis that we kept talking about in December, that was leading up to eventually some kind of reset in the market anyway. And that's where we had those positive extremes. If we shrink this back, we can take a look at where that pop originally came from. We had the dip below the red lines over here, and then we started to get the positive extremes when they were right in the middle of that, and here it was. So right around middle of November, was the early part of the repo, and then we ended up with the breakout move that was right here when they had really fully begun it in December, providing that liquidity. But we were still looking at super positive with the shakeout and everything. It wasn't until we got to this first peak that we started making the lower lows, and that was the first reasonable reading that came through. It just came across, and then new buyers popped into it right about the even spot. But still weren't able to make shakeout highs any better. And then so once this one started to develop, we knew that it was getting close. We had perfect ABM split between the 176 and the rest was, well, pretty straightforward. Even when we had this with the violent buyback, we knew we were still at a negative overall range because we weren't seeing a steel reset. So the point was when we got above the 13.5, it was just a matter of looking for the dip to come back and an eventual spider. When that spider took place, that became another opportunity. Even though we were breaking down around that 2867 level, we had retested the lows from the dip below the red line that we knew we were coming back to even on this pop. And so that all worked out exactly like we thought it would. And nice. NASDAQ, same situation. Though you can see with the dip below the orange, the potential is you've got a lot of this new money coming in. Shorts have been covering a lot of this, but again, still no steel reset. So any pop we're going to be getting is still going to be under pressure. It doesn't mean we aren't going to see some moves up, but when I hear a lot of people wanting to go long and stuff like that, I just want you to be cautious that you're going to have to actively trade those setups as opposed to just think that they're freewheeling super longs. With that said, moving on. The euro. All right, so those are the two bands that we've had in here for, I think it's been well over a year plus. Because this was the range that had been agreed upon for the euro. We had spiked above it for a little while last year. I think we had to shrink this chart quite a bit to see where that was. And it's right over here, we were at the peak, and then we had this nice reject reaction because you had so many people that were shorting it, and the central banks every time it hit there got involved, and that created a short cover. But we knew the euro was still in trouble. We knew it was going to retrace all those because we had the positive extremes right here that took us all the way back to this 108. And you can go back in the videos we were talking about. It's just a matter of waiting for it, and sure enough, now we've broken down below this 106, 104 range. Becomes another critical test because below that it's going to be tough for them to hold parity on it. Is there much of a real desire to be? Yes, they came out with their $750 billion stimulus or whatever, but the ECB is completely bankrupt. Deutsche Bank was already in trouble prior to this. All Italian banks were pretty much illiquid anyway, so it's just pretend at this point. And that's what happens when central governments get involved, because they have unlimited capability of just making up money. So that's what they'll do. But we're already seeing the effects of it. 2 days ago, you could get a baguette here in Florence for 85 cents. Today, $2.50. And the price of all meats and other products have gone up a good 30 to 40%. I would expect that hyperinflation to start amplifying itself, particularly as shortages become more widespread. It just means that the supply chain disruptions that I talked about a while ago are starting to manifest. You're going to see the same situation develop in the U.S. Yes, the suppliers say they have plenty of product in that, but as distribution becomes more difficult, those costs are going to elevate, particularly as they have to implement additional safety precautions, and people, it's going to be complicated. So there's a lot of factors that go into some of these things. Oil, again, with the U.S. buying, that's going to help stabilize. Is it a cure-all panacea? No, because you still, again, have the distribution issues. Will we see, Texas cut production in that? Most likely, because you may not find the essential workers able to do it, and there aren't that many qualified people who can work in some of these plants. This becomes an issue if they become ill and that kind of stuff. Fortunately, you're a long way away from it, but not as far as you might think. Those numbers are getting to be quite interesting. You've seen the tallies more than triple in the last 4 days, relatively speaking. I mean, you were just almost a week and a half ago at under 4,000 cases. That jumped up dramatically in the last couple of days. Now you're reporting, over 20-some thousand cases. Well, that's even misleading, because as I've been talking about, the real way you have to calculate is the number of deaths you find in a particular place and multiplying by my 250 factor, which tells you how many people are actually infected at the moment, because we already know that if someone died, that means that at least, 100 people, if you're assuming just a 1% death rate. If you're presuming a 2%, you're saying, okay, for every 2 deaths, that's 100 or so people that were infected. But with the exponential infection rate, you also have to add another 50% factor to that, and this is where we start to get into that 250 number. Gives you a broad range of exactly how many are affected in a general region. This is some of the forward math we use for our algorithms, and this is how we stay ahead of where we are, where we're solving for an n that doesn't exist. And this is where we get some of these complicated number relationships between each other, because we're projecting into the future what has developed but has not come to final fruition is the easiest way to imagine that. But that's okay. We're just going to continue to go with it. Gold will start to stabilize once we've gone through this carnage of margin and everything else, and they're able to stabilize the conditions. So turning to our 5K chart. So this was a relevant topic that I think is significant. The original way I planned for the Diocon Paint 2 combined with our GAM function paint bars was to establish this setup that it treated the paint colors and those key signals as trades. And so what happens is when a particular candle color triggers, it creates what I have called a trade management setup, where it creates a stop based on the ATRs and then adjusts and follows along with the ABM. But as I pointed out, a lot of times the tendency is that when you capture a thing, you're just taking an arbitrary value and getting out. That isn't as effective as in some cases, like in this, just following the colors. So in this particular case here, I was pointing out, even if you bought up at the high at the 50% range, which usually you look for a little bit better move than that. Going here, this was one of those few actually I think it's the only exception to a cyan under red buy configuration, where you have the steel pops above steel, comes back below, and then within a bar or two you have DLC spread. And that becomes one of the few points. But in this particular case too, we also had violated the ABM green, and putting together the factor too, where the ATR between the 76 and 100% becomes too large. There's always a mean reversion. Now in this particular case too, we had just a ton of positive extremes for expectations for retrace. So, but even still, following that, likewise, again, I'm going to be doing a separate video on the different colors of these, like the orange setups and that explain all the little factors that are going into these colors popping up. Oftentimes with these, what I'm looking for when they show up is it's letting me know that the buy potential exists, but you've also got to continue to meet the criteria. And this is where the no steel reset comes into play, because when I don't have a steel reset on these, I really need to be seeing green taking charge of the situation. And in this particular case, like here, with the orange, you don't have green doing what you would want. You really want to see that one make its first uptick before you're even thinking about buying, which is right here where the P2X pops in place. And then in this case, you actually had the ABM reset at that particular point as well. But you can see the numbers this produced. It was 89 on the rise, 63 going down here. Even if you had this one, probably would have been net zero to slight gain, because you had the ABM rise up above and then it broke down below here on this rejection which is a perfect one too. This is something I look for, where I call my quad setup, where steel dips below cyan, number 1, orange above steel, number 2, green below red, number 3, red falling, number 4, and this gives you that whole combination in perfection right there for a signal down. And then even when it triggered that buy configuration down here on a P2X setup, even if you were right across, again, before it produced the sell signal, it was another 46. I showed this trade after I had been doing these. This is the one where I just bought and held and decided, okay, I'm just going to hold on to this because the market is still in a horrible condition, and we'll just follow it. And all I was using was just 100% Morganacci lines as we were going down, and after they stabilized for a while, I would just take them after a couple of flat bars and just reduce to it. And so when we were having some of these buy spikes and people were talking about being long, it's like, well, there's nothing wrong with that. For some of these moves were pretty decent from an upside. I was just doing other programming work, but I just wanted to show you how even utilizing that, it's like now still, effectively the stop would be up here. Now that I have declining highs, I've got to be more cautious looking for those significant buy setups where you have really improved shakeout and potentially move back up to the 50 where you have rising gold tends to produce. But nonetheless, you can see how effective from a day trade standpoint that can still be. So I'll let you know when I have the separate video that goes through each of the conditions that make up these individual candle ones. But often when they pop up, they do give pretty good signals that you're still going to maybe have some stress on the setup, but that's why sometimes they'll remain green for a while going through there. And this is my whole point about the market. Not every signal within the DOC is the same based on the conditions that have developed and where we are in the market, both vis-a-vis the Morganacci lines that are here, and it creates these unique setups. And this is also in conjunction with the shakeout too, because rising gold in these cases is very different than just having the exact same reading from a DOC where you have falling gold, completely different, and one's weak and one is much stronger. So those are important factors, but I try to put as much of that into some of these codings, and that's why I've created the functions for each of these different, both the P2s and the P3s, and you'll get some of them where it is a pivot, but didn't produce an X because it didn't have the criteria that was justifying what would be, considered significant enough for, looking at it from a buy standpoint. So when that one's put together there, you'll have a pretty clear understanding of where some of those go. But again, this is the whole point of the colors, because even just trading those, very effective. A little bit long on this one, but I wanted to go over that since this was a monumental weekend, very significant. If I had to recommend a site that's been pretty good with the information about what's going on, ZeroHedge.com. They've been around for a long time. They've been super pessimistic during a lot of the uprise, but now that things have moved to a negative standpoint, I always keep track of both bulls and bears when it comes to information, just to see what data points are pointing to. And what we ended up with was a lot of companies that were very highly leveraged, that it's fine when things are going well, but once you move 2-3 standard deviations from normal behavior, the positions become untenable. And this is what happened on the arbitrage guys, and then that starts to spread through market liquidity. So when Boeing said, hey, we suggest everybody take down their credit lines, they knew it was going to happen, because there would be a credit freeze, which has already taken place amongst banks and that. So we'll see if they're able to, we've got some promising news on some treatments for it, but the treatment's not the same as a vaccine, which means weeks, months before things start to normalize. And, despite China claiming that they have no new cases in that, there are still reports where people are still being tested positive, and it's just not getting reported. But we knew China had been lying from day one. It is interesting, China Mobile in that was reporting 8.1 million fewer cell phone users, which is interesting because they had always been reporting increases in cell phone use, but for January and February, down 8.1 million. What did 8.1 million just decided to, we're in quarantine, so we don't need a phone anymore? when that was their sole source of real technology, because landlines weren't as like a thing? Or did you have some fraction of those 8.1 million die? That's probably going to be closer to the truth, but those are the kind of details that you look for. I think now what you want to be watching for is people showing up at hospitals in larger number in the U.S. That will indicate whether or not the severity of things is going to start to ramp up, or if some of this partial quarantine will slow the curve. Because that's really what they want. They just don't want that overwhelmed hospital status, because that will create panic. And when there's panic, you know the markets are going to react to that in a broader issue, particularly if there's not a stabilization for business and a way for people to actually keep the economy moving beyond just essentials. So that's the long and the short of it for now. As always, it's going to be a fluid situation. We'll keep going at it. We're still going to see pops and drops, and overall, at this particular point, it's still a negative bias that hasn't changed much. But as you can see from the DOC readings on the daily and that, they were starting to improve. We put up a 50K, has not shown. I don't have a peak going on this one, but you're still well below the negative 13.5. We had a slight dip here, but this has all been under steel reset. That last point was right back here in the middle of a decline, so there was no change there, and we're still making new lows. So until that changes, we'll see it popping hard just yet. But with futures being able to open up so dramatically at low liquidity, it gives them an opportunity to manipulate it to try and hold things up a while longer. So we'll see if they're able to do that. But overall, comfortable with what we've been talking about and how effective it's been for these last couple of weeks during probably one of the greatest market carnages outside of the most recent one of 08 that a lot of us experienced, and we saw that at the time. And it's funny, I was looking at Facebook and had the Trade DMBI had a 10-year plus anniversary photo come up, one that Amy had put up. I didn't even know that she had posted about it. That was quite a while ago, but we've been effective on this market for a very, very, very long time, so it's all good. As always, though, trade well. We will talk again later.